Welcome back to our series on technical analysis for crypto traders. I'm Justin Wise, and in today's video, we're diving into the world of candlestick charts. By the end of this video, you'll understand the basics of Candlestick Anatomy, the significance of various candlestick patterns, how to properly interpret these different patterns, and how to leverage this knowledge alongside other technical indicators and methods of technical analysis to not only improve your trading strategy, but make better trades. Let's get cracking. Part 1, Anatomy of a Candlestick. If you look at the price of an asset on CoinMarketCap or CoinGecko, you'll generally see price displayed by default as a line. In contrast, when you start charting on a platform like TradingView, the default will be candlesticks, which is my preferred way to view price action. To begin, let's break down the anatomy of a candlestick. What does it all mean? Each candlestick represents a specific period of time depending on the time frame of your chart. In this example, you can see that I have the 15-minute chart selected, so each candle represents what occurred over 15 minutes. If you're looking at an hourly chart, then each candlestick will represent the buying and selling activity that occurred within that 1 hour, and so on and so forth. Each candlestick has two main components. First, there's the candle body. This shows both the opening and closing price and the distance that price traveled within that time. Candles will either be green or filled or red or unfilled. This tells you whether price closed higher than it opened or lowered. In this example, we have a red candle. Therefore, that is letting us know that price closed lower than it opened, and over that 15 minutes, there was bearish price activity. So price opened at this level and closed at this level, in other words. In other words, this was price at the beginning of the 15 minutes, and this was price at the end of the 15 minutes. Next, there's the wicks. These are also called shadows or tails. These are the thin lines that stretch above and below the candle body, and they tell you the highest and lowest price that that asset reached within that time period. The color and size of the candlestick body and wick can help you quickly identify what the direction and momentum of price was over that given time. For example, a large candle body like this one indicates that there was a lot of selling pressure, meaning that the sellers were able to generate a lot of momentum over that 15 minutes and push price down fairly significantly. In contrast, if we look at a candle with a small candle body, we can see that the sellers were not able to generate very much momentum over this 15 minutes and that they were showcasing significantly less strength, potentially meaning that they're running out of steam. The size of the wicks can also be quite significant, as it indicates the amount of disagreement or battling between buyers and sellers in the marketplace at any given time. For example, if we look at these two candles, we can see that there are long wicks or price tails to the downside below price, but we also see that both of these candles were able to close much higher than their lows. What this tells us is that over those two 15-minute candles, sellers tried twice to push price down, but each time they did, buyers aggressively bought price back up and were able to successfully close price very near where it opened, meaning that although sellers tried, they weren't able to accomplish much. In summary, each candle has two main components, the candle body and the candle wick, and each candle will give you 4 pieces of information: the opening price, the closing price, the price high, and the price low. Part 2, Candlestick Patterns. As I said, the color and size of the body and wick help us determine market momentum and direction. Specific combinations or patterns of candlesticks often indicate the likely direction and momentum of future price action. In this section, we'll cover common bullish and bearish and neutral candlestick patterns and what they often imply for the future. We'll start with bullish formations and patterns. As the name implies, these are formations or candlestick patterns that often indicate that price will rise. The most common you will encounter is the hammer candle. A hammer candle is a candle with a small body and a long lower wick. It signals a potential reversal from a downtrend to an uptrend and is one of the most sought after reversal signals. The justification for the idea that this is a reversal signal is that in the time of that candle, sellers attempted to push price lower, evidenced by the long wick below the body. However, buyers were able to step in and successfully push price back up and close it at a higher price than it opened. This indicates seller weakness or exhaustion, and that seeing this, more buyers will likely enter the market, continuing to push price higher and reverse the downtrend. Next is the bullish engulfing candle. This formation occurs when a small bearish candle is followed by a large bullish candle that completely engulfs the previous one. It suggests a strong upward reversal or continuation of a bullish trend. Note that although this candle is considered bullish, its strength and significance depend on the market environment where it occurs. If it occurs during a bearish downtrend, then it is a sign, like a hammer candle, of seller exhaustion or weakness, as sellers who had previously been in control have been temporarily overtaken by overwhelming buying pressure. On the other hand, if it occurs within an uptrend, it often happens after a period of consolidation or tightening price action, and serves as a signal that the uptrend is about to continue. The second example is a common breakout trading signal, while the former is a common reversal trading signal. The three white soldiers is a common bullish pattern, consisting of 3 consecutive long bullish candles, often with small wicks. This pattern indicates that buyers are very strong and that sellers are unable to stop their advance, evidenced by the lack of wicks to the downside generally. This pattern indicates the initiation or continuation of a bullish trend. The morning star is a 3-candle pattern that signals a bullish reversal. It starts with a longer bearish candle, followed by a smaller candle, often a hammer candle, and ends with a long bullish candle. This pattern is considered stronger if the bearish candle is smaller than the last bullish candle, and even stronger if the last bullish candle completely engulfs the first bearish candle. Simply put, this is another sign of seller exhaustion and of buyers stepping in with strength and momentum, and often signals an upwards trajectory for future price action. The double bottom is a pattern that forms after or during a downtrend and consists of 2 candles with lows at approximately the same level. This pattern indicates a potential reversal to the upside. It's also called a W bottom or W pattern, as it happens when price falls to a low, rebounds a bit, then finds support at the same low. If price begins rebounding again, it confirms the double bottom pattern, and most traders will wait for price to close above the neckline. That is, the high that was formed on the first rebound before entering into a long position. This is a reversal pattern I often watch for in my own trading. The tweezer bottom is similar to a double bottom, but this occurs when 2 consecutive or nearly consecutive candles have the same or approximate low. This pattern is considered stronger when the second candle closes higher than it opened, and even stronger still if it is a large candlestick. Again, this is a common reversal pattern that often indicates seller exhaustion and an upwards trajectory for price. Next, let's cover bearish formations, the opposite of bullish formations. As its name implies, these are patterns that indicates that price will go down or fall. The shooting star is the most common bearish pattern that you will see. It is the brother to the hammer candle and is sometimes simply known as an inverted hammer candle. This is a candle with a smaller body and a long upper wick. It indicates buyer exhaustion and often signals a reversal of price to the downside. The bearish engulfing candle is the opposite of the bullish engulfing pattern. This is a smaller bullish candle, followed by a larger bearish candle that completely engulfs the previous candle's range. This indicates a potential downward reversal or continuation of a bearish trend following a period of consolidation. The 3 black crows pattern is the twin to the 3 white soldiers. This pattern consists of 3 consecutive longer bearish candles, generally with smaller wicks. This pattern suggests a strong and persistent downtrend or the beginning of one. The evening star chart pattern is the bearish counterpart to the morning star chart pattern. It starts with a longer bullish candle, followed by a shorter candle, often a morning star candle, and ends with a longer bearish candle. It is a strong reversal pattern and often indicates the end of a bullish trend and the beginning of a downtrend. The double top chart pattern is the opposite of the double bottom. This pattern forms after an uptrend or during one and consists of two highs at approximately the same level, indicating a potential reversal to the downside. Often called an M pattern because it takes the shape of the letter M. Like double bottoms, traders will often wait for price to close below the neckline before taking a short position. Again, this is a pattern I watch myself for in my own trading. The tweezer top pattern is the opposite of the tweezer bottom. This pattern forms when two or more consecutive candles share the same or approximate high. This is stronger if the second or subsequent candles close lower than they open, and stronger still if they are larger bearish candles. Now that we've looked at bullish and bearish patterns, next, there are patterns that are neither bearish or bullish in themselves, but rely entirely on the context of when they occur. Depending on that context, they can be interpreted as bullish or bearish, and this is where your experience and discretion will come into play. The most common neutral candlestick is the Doji candle. This is a candle with no significant body and price wicks both above and below the body. This candlestick indicates indecision in the market, as it shows that buyers and sellers fought tooth and nail, pushing price up and down, and neither really getting anywhere, thus the small candle body, as the closing price was very close to the opening price. Variations include the long-legged doji, which is a doji with long price tails, the gravestone doji, which is a doji that occurs during a bullish uptrend and can serve as an early warning sign of a potential reversal to the downside, and the dragonfly doji, which occurs in a downtrend and can often serve as an early warning sign of a potential reversal to the upside. Next is the spinning top, also known as a spinning top doji. It's similar to the doji, but with a larger body, generally with tiny wicks both above and below price. Like the doji, it indicates indecision in the market, with both buyers and sellers having equal influence. The Harami is a two-candle pattern where the body of a small bullish or bearish candle, known as the child candle, is entirely within the previous larger bearish or bullish candle's body, known as the parent candle. The child candle is often opposite in color to the parent candle, but it doesn't have to be. A Harami is often considered a reversal pattern, so identifying in what sort of trend it occurs in is critical for determining future price action. Next up is the inside bar pattern. This is similar to the Harami, but a little more restrictive. With the Harami, we're only concerned with the child candle body closing within the body of the parent candle, while its wicks could extend above or below. With an inside bar pattern, the entire range of the child candle, wicks and body, has to be contained within the range of the parent candle. We're not concerned with the body. Unlike the Harami, which is considered a reversal candle, the inside bar is considered to be a sign of consolidation and indicates that there is going to be a potential breakout soon in either direction. Part 3. Combining candlesticks with technical indicators. While understanding candlestick patterns can be a powerful tool in your tool belt, combining them with technical indicators or on-chain analysis will give your trading strategy a greater edge. Technical indicators can help confirm the signals provided by candlestick patterns, and on-chain analysis can provide you a fundamental reason for wanting to trade in a certain direction. All of this combines to reduce the amount of false signals you receive and strengthen your conviction in the trades you take. For example, a common trading strategy involves using a momentum oscillator like the relative strength index to gauge whether price is overbought or oversold. When you notice that the RSI is at an extreme and you see reversal candlestick patterns, the momentum oscillator is helping to confirm and strengthen the signals that the candlesticks are giving you. In this example, we have price overbought on the 15-minute time frame with an overbought RSI. We notice an evening star pattern appear, and price does indeed reverse to the downside. Contrast that with this example, where the RSI is not overbought, and instead of price reversing, price continues upwards. On-chain analysis can strengthen your trades even more. Analyzing factors such as wallet holdings, on-chain transaction volume, and cost basis levels for different token holder cohorts can help give you a fundamental reason to trade in a certain direction, allowing you to ignore contrary signals and only focus on ones that align with your fundamental analysis. By combining technical indicators, on-chain fundamentals, and technical candlestick patterns, you'll have a stronger trading strategy and a greater edge in the market. Part 4. Volume Analysis. A discussion of candlestick patterns wouldn't be complete without talking about volume. Volume should play a significant role in your analysis, as it strengthens or weakens the signals that candlesticks, indicators, or fundamentals will give you. Simply put, large volume equals a stronger signal and a larger resulting move, and weak volume equals a weaker signal. Regardless of what pattern you see, if traders aren't putting any conviction or size into it, then the market is not likely to move the way the pattern suggests, and even if it does, not with any gusto. In this example, we can see an evening star chart pattern where we have a larger bearish candle followed by a hammer candle and then a bullish engulfing reversal candle. This is a strong reversal candlestick pattern, and notice how it occurs on very high volume. And therefore, the resulting movement away from that pattern is significant and worthy of a trade. There was a lot of profit potential to capture there. Contrast that movement with this one, where we have an equally good-looking evening star pattern. However, notice the volume is significantly smaller. Therefore, although there is a movement away, it is certainly not as strong as the first move and actually doesn't have any follow-through after a few hours. In summary, understanding candlestick charts is fundamental for any crypto trader. By mastering the basics of candle anatomy, recognizing key formations and patterns, and combining these insights with other technical indicators and on-chain analysis, you can strengthen your trading strategy and develop a more competitive edge in the market. Remember, no single tool or technique will bring you infinite riches, and technical analysis is not a magical tool for instant profit. Adopt the learner's mindset, constantly seek to grow and improve, and most importantly, stay humble, as the market will humble the arrogant. Thank you so much for watching all the way to the end of the video and joining me for this episode of Technical Analysis for Crypto Traders. If you found this video helpful, don't forget to like, subscribe, and hit that noti bell for more great content. And if you're ready to make a more serious commitment to trading, I invite you to apply to our Crypto Trading Academy, where we've helped thousands of students from across the world build profitable strategies, mentoring them through the most chaotic of market environments and always seeking to supply them with the best tools and techniques available. Link is in the description. Trade safely, and I'll see you in the next one.